Corporate finance presentation, long-term debt and lease financing overview. Get ready, it's time to take your chance with corporate finance. Debt financing. Expanding capital-intensive industries have expanded the need for debt financing. So if you're talking about industries that need a lot of cash, need a lot of capital in order to grow, then that expands the need for debt financing, often in the form of corporate bonds. Funds from company operations may not be enough to pay for the capital-intensive industry growth. So if you're looking at a type of industry that is capital-intensive and they're trying to grow, they're trying to capture a larger market share, you might say, why don't they just then take the money from their operations, reinvest it in order to fund the growth? And in a capital-intensive type, and they could do that basically instead of, you could say, you can either put it back into the company instead of basically giving the dividends out. And that's one way that you can fund the growth. But if you're looking at a capital-intensive industry that needs a lot of money in order to grow and possibly lock down market share, it might not be enough, and therefore the debt financing could be taken in consideration. Companies may go through recapitalization by using bond sales to purchase common stock. So to rebalance or to balance out their financing between the equity financing and debt financing, they could also use the issuance of the bonds to purchase the stock for that purpose as well. Corporate bond is the standard long-term debt instrument. So when you're looking at the debt instrument for a publicly traded company, then the bonds is going to be a huge option that allows access to more capital for it. The company then issuing the bonds and being able to issue the bonds to a wider range of individuals, possibly to, of course, individual investors, allowing for a lot more access to the funding, hopefully. So the bond is going to include, as we've seen in prior presentations in prior sections, a par value to it. That's the initial principal or face value of the bond. So you might see it as par value. You might see it as the face amount of the bond. We'll have a coupon rate, which is the interest rate that is on the bond. So you're talking coupon rate is basically the bond rate, as opposed to the market rate or the yield to maturity, which is not on the bond, but driven by the market. And then we have the maturity date on the bond. That's the date the principal payment will be due at the maturity. So you got a very well-structured kind of security here, typically, and that the major components, the par value, the face amount, the coupon rate on the bond, and the maturity date. Security debts have assets pledged to the bondholder in case there is a default. So if your debt is secured, then you have that situation where you have assets pledged to the bondholder, in this case, the bondholder, in case there is a default. The assets do not usually need to be sold and proceeds distributed. In other words, you have this in case of hopefully like an emergency. If there is a problem, if the company goes into bankruptcy or something like that, then you have a situation where basically they can sell the assets that's securing the debt, you would think, and use those proceeds in order to pay off the bondholders, allowing them more security, less risk of the event, of a catastrophic event, something happening, bankruptcy happening like that. They still have security that they'll actually get paid on the bond. So a mortgage agreement is a term that denotes collateralized or secured debts related to real property pledged. And a mortgage is probably where most individuals have the most experience with something like this. Because in the instance of a home, taking a loan on the home, then usually the home itself is going to be securing the debt for the loan. So if someone was to default on the debt, then you often hear that the bank's going to take the home, and they are, but they're not really going to take it so that they can kind of hold on, right? They're going to sell the home, and they're going to get the money so that they can then pay off the loan. That's going to be the idea. Same idea if you're securing with something else, some other type of property. If there's a default on it, if there's some problem, if there's a bankruptcy that happens, then you take the assets that are securing it, sell it, and then pay off the debt holders. Now, no one really wants that to happen because we just want things to go well, hopefully, and the debt holders to be paid off. But if there is something that happens, then you have that added level of security, reducing the risk level. So secured debts offer higher protection and lower risk, resulting in lower interest rates on the bonds. So if you have a bond that is secured, if you have better security on the bond, then you're going to have a more protection. You have less risk. And because there's less risk, then the the person issuing the bond is usually going to be able to issue it at lower interest rates. You're not going to get, in other words, if you're buying the bond, you're typically not going to have as high a return as you would have with a more risky bond, because you have that lowering of risk in the market. When you put that lower risk asset on the market, people are willing to pay for it and take less return on the investment for it because of the lower risk. So unsecured debt that is not secured may claim to a specific asset. So debt that is not secured by a claim to a specific asset is unsecured debt. A debenture is an unsecured long-term corporate bond with a general claim against the corporation. So if you talk about a debenture, you have that unsecured situation, just a general claim against the corporation. In other words, if there's a problem like a bankruptcy, they may have less ability to pick up the debt in that situation, which of course increases the level of risk related to the unsecured debt and related to the debenture. So subordinated debenture, which is even lower down, the payment to the holder happens after designated senior debenture holders are satisfied. So if we look at the structure, it looks something like this. Let's say there was something that happened, a bankruptcy or something like that, then who would get paid in that instance? You're going to have a limited amount of money. Who gets paid first? And where's the pecking order in terms of who gets their money first? Now, usually in this instance, it's kind of backwards to what you think about for like the ownership. Obviously, the owners are like the stockholders, right? But if you go into bankruptcy, you have to pay everybody else first and then pay the owners. So they're kind of last in line in the event of something happen. That's why they're also the ones that are going to get the benefit in the growth, right? They're taking on the risk. The bondholders are the ones that are basically are going to be getting paid back first generally, and that's part of the benefit of being a bondholder. Although if the company grows, then they're not going to get any added growth to the bond, right? So the bad thing about a bondholder as opposed to a stockholder, an ownership of the company, is that the bond you're just going to get paid back with relation to whatever the terms of the bond are, no matter even if the company does really well. Whereas the common stockholder, of course, will benefit as the company does really well because they're going to be the owner in the company. But if there's a default, if there's a problem, then the bondholder is more secured against the low side, and they're more likely to get paid off first, unless the government comes in and does something funny and messes up the whole structure. But in any case, that's going to be the idea. So the secured debt would basically be paid first, you think, right? Because if there was a bankruptcy, they'd sell off the assets. The assets related to the bond debt here would get paid first, and that would typically go to if there was a senior and junior secured debt, first to the senior has the first claim to assets pledged. So whatever assets were pledged to secure the debt, kind of like the home being pledged to secure like a mortgage, those assets being sold then would be money being used, would be paying off the senior, and then the junior that has the second claim to the assets pledged. Then we have the unsecured debt. So these are the debentures now. And once again, we have the two levels of the senior and the subordinated. And then we've got basically the equity side of things, the preferred stock being ahead of the common stock. And that's one of the things about being preferred. When it says preferred, they're usually going to get paid first with regards to the dividend distribution, oftentimes, generally, and in the event of a bankruptcy or something like that. So once again, you would think that the preferred stock, if you just looked at this, you'd say, hey, where do you want to be in this line? I want to be over here, right? I want to be the secured debt holder. I don't want to be the common stockholder. And that seems kind of backwards. If you're an investor, most people are kind of investing and they're thinking they're going to be buying the ownership and the common stock. And notice it just depends on what you're looking at. You want a balanced portfolio and whatnot, right? The bonds over here are looking really good in the event of a bankruptcy or something bad happening because they're going to get paid off first. That's the point of being on the bond side of things. There's less risk. The terms are set. You know what's going to happen. It is what it is. Whereas if you're the owner of the company and the company does well, it starts to increase in value, then you're going to get more of the benefits. The bondholder over here is still going to get paid off whatever the term of the bond is. They're not going to get a bonus because the company made a lot more money. whereas the common stockholders may very well get a bonus either in the form of a dividend, or they might get a higher increase in the value of the stock itself, which they can then sell if they so choose. So it's interesting. So that's why the balance comes in. Obviously, when you're looking at the portfolio, you're looking at a balance between risk and the possible returns on it and whatnot. So we have the repayment of bond methods. So we have the single sum payment at maturity and is the most simple method. So in other words, if we issue the bond, then how are we going to repay the bond? Well, one easy way to do it, maybe not the most common way, but you could just say, well, I'll just have a single sum payment at maturity. And that would be very easy then to look at. We're just going to issue the bond and pay the payment at maturity. Usually you have the serial payments. That's what most people think of with a bond, which is paid in installments over the life of the issue. And then we could have a sinking fund provision where we have semi-annual or annual contributions made into a fund run by a trustee, a converting the debt into common stock. So we might have that as a component of the bond. And we could have a call feature, which means we retire or force in debt issue before the maturity date.